Today, more clues to further home price falls. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. DFA research was featured in a number of the weekend papers today, discussing the rising number of mortgage loan applications which are being rejected by lenders due to tighter lending standards, meaning that many households are unable to access the low refinance rates that are currently on offer. And by the way, if you value the content we produce, please do consider joining our Patreon program, where you can support our ability to continue to make great content. Here's the link, and it's also in the comments below. The newspaper article said nearly half of all homeowners are now shackled to their mortgage, with refinance rejections up significantly in less than a year, as banks are rattled by the Royal Commission drastically tightening borrowing rules. Loan sizes are being slashed by up to 30%, trapping many financially stressed customers, including some who have been slugged with out-of-cycle interest rate rises. House hunters are also being hit by the credit crunch, with dramatic implications for property markets. The crunch stems from two big shifts in the way banks judge borrowers. Expense estimates have been raised substantially. The minimum outgoings for an average household are now assumed to be a third higher, according to bank analyst UBS. And on top of this, granular cost breakdowns must be provided. After the Royal Commission revealed in March that expense checks were so lax as to be borderline illegal, new tests have been imposed, requiring in some cases details of weekly, fortnightly, monthly, quarterly and annual spending in as much as 37 categories, from alcohol and hair care to shoes and pets, as well as doctor's visits. As a result, we think that now 4 in 10 households would have difficulty refinancing. That means you're basically a prisoner in the loan you've currently got. This is based on our 52,000 household surveys, plus data from a range of other sources. We estimate that 31,000 households' refinance applications were rejected in July, compared with 2,300 in August last year. And comparison service Mozo's lending expert, Steve Josephik, said there's such a huge pool of people who are in that boat. The most common motivation among those seeking to refinance was to save money by finding a better deal. Many were feeling the pinch because living costs were rising faster than wages, and rates on interest-only or investment loans had increased. The main issue these households are facing in seeking a new deal was banks' definition of what a suitable loan now is, and it's so different to 6 months ago because of the Royal Commission and a clampdown by the Australian Prudential Regulatory Authority, or APRA. So there has been a big rise in loan rejections, particularly for refinancing. The borrowing power of households are being crimped, as shown on the bank's website mortgage calculators. Those calculators, compared to a year or 18 months ago, are now on average showing a 30% lower number. For some, the reductions in borrowing power is even greater. The head of UBS's bank analysis team, John Mott, said that for a household with pre-tax income of $80,000, they would get 42% less from a bank, and for a $150,000 household, they could access a loan 34% less. And Moser said that there was one example of a person pre-approved to borrow $630,000 last year was recently offered just $480,000. The would-be borrower's job and income hadn't changed. The implications for property markets were severe. There are fewer qualified buyers. Reduced borrowing power would drag down selling prices and eventually cut valuations. And that's a double whammy for those mortgage prisoners. Their valuations come in lower, so their equity may end up being less than 20%, so they have to pay lenders' mortgage insurance again. Now, Australian Banking Association CEO Anna Blythe said banks had to make reasonable inquiries to satisfy APRA's strengthened mortgage lending standards. But she said that the term home loan prisoners does not represent the facts of a fiercely competitive home loan market where everyday banks are seeking to attract new customers. But Mozo said homeowners seeking to give themselves the best chance of successfully refinancing should reduce their expenses in the months prior to applying and to ensure that all bills have been paid on time. And Mark Hewitt, the General Manager of Broker and Residential at AFG, which arranges 10,000 home loans a month, said would-be borrowers whose budgets were at breaking point or beyond could still get a loan if they had equity, a clean repayment history, and the ability to ditch key expenses, such as fees for private schools, if under the pump. Some people seeking their first home loans are signing documents in which they promise to cut their spending if a new loan is approved. When you get a mortgage, you make sacrifices. You continue some of your discretionary spending, but not all of it, said Brett Spencer, head of Optica Group, which sells software to brokers that work out how much a prospective customer can cut back. A figure is agreed between the broker and the would-be borrower, which is then provided to the bank, which would otherwise rely on the higher raw expenses figure. Now, this makes an interesting point. Mortgage brokers will be diving into household expenses more than ever before. But of course, households saying that they can cut their expenses to get a loan is not the same as a clear cash flow. Thus, even in this tighter market, the industry is still trying to find ways to bend the affordability rules. And it's worth remembering that according to the latest figures from APRA, more than 5% of new loans currently being written are outside standard assessment criteria, and that's a lot higher than it used to be. This suggests that even now bank lending standards are still too loose. And all this points to more home price falls ahead, and this is reinforced by the latest domain auction clearance rate data, which was released yesterday, and shows that the final auction clearance rate last week in Sydney, Melbourne and nationally ended up below 50%, way lower on both volume and clearance rates than a year ago. And yet, despite all this, some are still spruiking the market, saying it's a great time to buy. We just do not agree. If you value the content we produce, please do consider joining our Patreon program, where you can support our ability to continue to make great content. The link is in the comments below. And as always, if you like what you've seen here today, please share and like the post and add a comment or question. I do read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you've already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.